Welcome back, everybody, to another video series, Tips for Mortgages. My name is Mike Parkinson, mortgage broker with Dominion Lending Centers in Campbell River, British Columbia. This is my cousin, Jaden Bax from Avenue Financial, just outside of Calgary. Morning, Jay.
Morning. How you doing today, buddy?
Good. Nice to see you back into Canada after your holiday. I see you're starting to lose your tan there, kind of like me.
Yeah, I'm trying to get as pasty as you. That's my goal.
Oh man, the lighting in here, all the lighting in my office.
Of course,
It's nothing to do with my tan or anything. So anyway, we're gonna get back to our weekly kind of mortgage rate series here. We did one last week, but we're gonna try to where things are at right now. It's complicated, so we're gonna try to keep you up to date every week and 2 weeks max on what we're seeing out there, what we're kind of learning every week about possible rates, where they're heading, what our opinions are. So let's get right into it. So anyways, last week we talked about different things about Bank of Canada. We think that they're probably going to pause now for a bit. That's what they're saying. Macklem's saying anyways, possibly another slight increase depending on the data that comes out. I see the US came out with a crazy jobs report last week. What was it? 517,000 non-payroll jobs, which is, I think, bogus. But I mean, there's a lot behind that. If you rip apart that report, like what kind of jobs are they? Sometimes they're counting 2 for 1. So there's a lot of things to that. So I think the U.S. is definitely going to continue to raise rates over the next, quarter or two. But I think they're going to go higher than what Canada needs to go because it's a little bit different. We have a lot more debt here, and we're a little more rate sensitive than they are, as well as our mortgage terms are a lot shorter. They typically do a 30-year fix kind of thing, so they're not as sensitive as we are. What are you seeing out there, Jay?
Yeah, absolutely. Well, what I'm seeing is what people probably right now would consider to be incredible value on the 5-year fixed market. Sorry, excuse me. Let me rephrase that. They're seeing an incredible deal, but it's not valuable, right? And that's the way that I look at it. And we've talked about this week on, week off. But in that insured side, when you put less than 20% down, you're paying mortgage insurance. We're seeing rates come down to about 4.5%, kind of in that region.
Yeah.
We could probably push that down a little bit with the right lender that does some rate matching stuff, but we're still shying away from that, and we're still, both you and I are going more towards either the variable, which is over 1%, 1.2% higher than that. Yeah. Just kind of seeing what's going to happen with the market over the next year and a half, or going with a 1 or 2 year fix. And same thing, we're looking at least, the general 1 or 2 year fix is around 5.5%. You can do a little bit better than that, but that's kind of generally where you're at. So, those are tough decisions to make as a consumer right now. How do I make a decision that I am paying 1% more than what's best available on the market in terms of rates right now? How do I justify that? And so how do we justify it, Mike?
Well, and payments it's tough right now because if you're looking at a shorter term, even a variable, like you got to qualify at such a high rate. So the first thing is you got to qualify for your mortgage. Yeah. So sometimes people have no choice but to look at a longer fixed rate because that's the only thing they can qualify for, and they have to understand that because of the stress test. Second thing is if you do qualify for a shorter fixed rate, like a 1 or a 2, and they're typically higher than the 3 and longer, is that it's hard to justify, like you just said, between 5 and 6.25 kind of rate, depending on where you're at, compared to what the longer term 5 years are much better deal today, right? So what you got to understand is if we're right and rates do fall, within the next year or so, then you're renewing at a much lower rate. That 5 and 5.5% 5-year fixed rate 2 years from now, you might not be super happy with that at all. So that's kind of the strategy that we try to discuss with people. In the end, the clients are in the driver's seat. If they're more comfortable with a 5-year fix, that's totally fine. Just have to understand the potential penalty if things do drop, in the next couple of years, which I think they will. The biggest thing they're talking about with interest rates right now is we're kind of at a mixed bag where a lot of people and analysts think, they're going to keep rates high for longer, which they could. Right now, there's really nothing that's breaking in the markets or anything. So this is giving them ammo to just keep these rates higher. But we got to remember there's a lag effect that we talked about every week. And it's going to start filtering through the economy, the lag effect of these high interest rate hikes. This is they haven't raised rates this aggressive, I don't know, in 50 years they're saying, or something like that. Like, so like when you raise rates 4.5% over a year span, something's going to happen, like with this much debt in the world. So that's what I keep coming back to, is throwing a bit of reality in there, because a lot of this stuff, the narrative they're feeding you, is a bunch of BS in my mind anyways. But for now, we're just going to keep plugging away with these higher rates until something breaks. They really need to. But if that's the case, then things aren't going to be good. And I think the rates are going to come down soon, quicker. I don't know what your thoughts are on that.
Yeah, no, we both feel that way. Like they're talking, fourth quarter 2023 into 2024 when they start to make those decisions. We both expect that to be earlier, but even if it's not, if it is the fourth quarter and into 2024, that 1 year to 2 year fix is a good strategy to get over this, where we're at with high rates now. The other side of the thing that I thought you said that was really interesting there, that almost nobody is talking about, and I guarantee that your banker isn't talking to you about, is when they're pushing you into a 5 year fix, is the penalty aspect of it. That penalty is calculated on a fix on several factors. It's how long you have left to pay in your mortgage. What is the spread between if you're with a monoline or the lenders that we work with? What is the spread between your contract rate and the rate of the day? And if you're with a big bank, it's what is the spread against the posted rate, which is even higher than your contract rate and the rate of the day, right? So there's so many factors that go into it. And statistically, we know the vast majority of borrowers are going to break their term within a 5 year term, right? Yep. It happens on a regular basis. It happens more than half of the time. Those penalties could be enormous, and nobody's talking about them. So if you think that the best deal is the best value, absolutely. We still continue to believe that the 5 year fix, even that it comes down faster compared to the other terms offered, we still don't think there's value there. We just think that it's there's a little bit of short-term thinking. If you're comfortable with that rate and you're going to lock into that, know that you're going to be there for the next 5 years. This is going to be that you're in your forever home. You're financially stable enough that there's no way that you're going to be forced into selling. You're tied to that location for whatever reason, right? And people always say, "No, I know I'll be there for the next 5 years." We've had a lot of penalty talks over the years with clients, haven't we, Mike? People who said that they would never leave who ended up leaving, right?
Well, and another option, if you're really wanting a little bit of a longer stability fixed rate, is a 3 year fix is awesome. Yeah. So for me, right now, I'd say the most popular fixed rates we're seeing is the 2 and the 3 year fixed. And a lot of people are taking the 3 year because it is lower than the 2, and they just want a budget for the next 3 years. And then, it's kind of it's a gamble, but it's not, because we don't know where rates are going to be in 6 months or a year or 2 years. We're just giving you our opinion. So if you're comfortable with that, that's a really good option to look at. So, a lot of people are taking the 3 year fixed right now for certain reasons. They just want to be comfortable with where they're at, budget for the next 3 years. So again, it's about us showing you options, and then you guys deciding what's worked for your family and your financial situation. So. Yeah.
And what we would ask today, this is, as we're talking to you today, if you've gone into the bank for a pre-approval, or you have a live deal and they've only offered you a 5 year fix and talked about, how great the rate is compared to everything else, please just give us a call. It doesn't mean that you have to pivot to us and work with us, but we're happy to talk to you. What else maybe your bank that you're working with has to offer, and give you some ammunition to go back and talk to them about, well, what about the 3 year? What about the 2 year? What are my options there? So you can have a more intelligent conversation about it. So anytime that you're thinking about buying and wanting to know what's going on with interest rates, call me, call Mike. We're always happy to have a discussion.
Awesome. Yeah. Thanks, Jay. And please pass this on to anybody that you think would benefit from this or is interested in what's happening with interest rates. Again, we're happy to chat with you anytime. Hope you have a great day, and we'll see you next week.
Thanks, guys.
Yeah.